In today's video, we're gonna do a trade review. Also got some big news, so make sure you listen to the very end. Looks like this is what Gary is trading. Looks like we have price action coming down into a previous level of structure. I was looking to see what you thought of the break and retest of 4-hour swing. Okay, so is this trade based on the 4-hour or based on the 15? Which one? Entries on the 15 structure. Okay, so I'm just trying to think of the progression. So do you start on the 4-hour as your higher time frame, and then you go down to the 15 for your trade entry? Is that the progression? Yep. Is the hourly or anything else used, or is it strictly from 4-hour to 15? 15 or hourly for the entries. Okay, perfect. All right. So let's start on the 4-hour. Let's go through our IPDE process. 4 hours, the higher time frames. This is where we're doing our IMP, identify and predict. And then hourly / 15 minute is going to be the decide and execute. So let's first and foremost see what we're doing here on the 4-hour, right? We can obviously say that price action, the most recent move, has been bullish, right? The overall move, not that it means too much here, the overall move on Pound Canada has been bearish. So long-term bearish, short-term bullish. And we're seeing a most recent kind of pullback right here into a previous level of structure. So we're in this bullish move within a bearish trend, and the most recent move is a pullback into this structure shelf. So if we just kind of like measure this out right here and go this and this and measure these ebbs and flows and ebbs and flows and ebbs and flows, we'll see that our last new structure high within the short-term bullish move is right here. We came down here, we extended up, and now we came right back into this previous level of structure looking left. And this is what Gary had on his radar as a key level to pay attention to. Price action then came down to this level. You can see here in the 4-hour, we rallied down, and then you can see a few things happening. One, specifically, this is called an inside bar, this green one. And an inside bar is a bar that completes completely within the range of the previous bar, which is called the mother bar, right? So an inside bar basically means consolidation. Again, if you think of the previous bar being bigger and the inside bar completing completely within the range, pretty obvious to see that, hey, this is range bound. I can't do it with the voice still coming back, Stuart. I can't do the normal inside bar. It's gonna crack, I can tell you. We can also look at the range of the candle getting smaller, knowing that market price action has slowed down, giving us consolidation. So it's a positive sign that the market is slowing right at a previous level of, again, this rejection wick right here, but right at a previous level of inside structure. So what Gary's doing is identifying the short-term bullish trend, identifying the pullback into a previous level of structure, predicting that this structure level is going to hold. And now he's deciding, okay, with a hold of that level, how can I get long in anticipation of the move higher? And this is where he's going down to either the hourly or the 15-minute chart for his entry. And he said in this one, he went down to the 15-minute chart. Just going back to the 4-hour real quick. Gary said it was also at a 618, so Fibonacci retracement from this swing low, so adding more confluence to it. This swing low to this swing high right here, and he had a 50/20 EMA supporting it. So let's go ahead and bring on an exponential moving average. We'll bring in 2 of them so we can kind of hop in Gary's chart and show you exactly what he's looking at. We've got a 50 burger right here. Let's make it white and a little thicker right there. Boom. And then we have our 20 burger right here. going into that level. So a few things. So with the moving average, how are those used in your trading? Is it just as a directional bias, looking at moving average confirming a trend, or does price need to be above them, touch them, or explain to me what role they play in your trading? And people use moving average for different reasons. One could be just support of the trend. So if longer term is above lower term, then boom, I use that to say that we're in a bullish trend. Or if range is expanding, meaning the moving averages there's a gap in between them, and the gap is a little bit subjective, but if there's a gap in between them, the bigger the gap, the stronger the trend, the smaller the gap, the weaker the trend. Some people will use them that way. Some people will use them actually for the physical touch, meaning they need to see price actually move into a moving average, break and close, or hold to get rejected at that level. So there's different ways to use moving averages. To be honest, I just see the supporting the move a good place to put our stop loss buy. Okay, so here's what we need to do. I don't think it's a bad idea to have moving averages at all, but they need to have a purpose, right? We don't want to have stuff on our price chart that doesn't serve a role, and then we're filling it up with junk and clutter, right? So we need to know what role does the moving average play in our trading. Does it play a role of I need to see it touched and rejected as kind of like a level of structure or like a Fibonacci? Do I want to have it play the role of trend identification, like I just mentioned, where I identify the trend not necessarily by drawing out ebbs and flows and new structure highs and outside returns, but by seeing which direction the moving average is in. So seeing that pink is above white, I know that we are bullish. If we were in this area where pink is crossing right, I know that there would be no trade call in here because it's the opposite, because there's no confirmed trend. Or I know that, hey, in this direction where pink is below white, I know that I'm bearish. So that'd be another way that we can use them. Or maybe we're using them for our rules on stop loss where, and this is you get a little bit iffy like this because moving averages are always changing. And then you have the question of like, okay, since moving averages are always changing, should my stop loss change as the moving average change? You can get into some trouble doing that. But maybe for your initial stop loss, I use my moving average to form my initial stop loss, meaning stops go at that 20 EMA or stops go 10 pips below the 20 EMA at the time. So that's one of the next steps you'll have to do, Gary, is like, obviously you like moving averages, you have them in there for a reason. Now let's define what role they play. Are they a role that has a key trading based rule associated with it? Or are they like a fib or an AB equals CD or a volume where it's confirmation? Think of it like a point in our CTS score where it's not necessary, but it does help our bigger picture. So that would be the next thing I would recommend. Think about how you use them, and then define that role, define that relationship. All right, so we go down to the 15-minute chart, and then again, what time frame you use them on matters too, and how you use them. Because again, you look at the differences here, right? Everything on this moving average is confirming a bullish trend. Would you guys agree? On our 4-hour, we drop down to an hourly. Well, now we got a different story. And this is where you get some more confusion as a trader, where it's like, okay, well, I got one signal on a 4-hour, but now on the hourly, I got a bearish signal where I should have entered at. Wait a minute now. What do I do? So this goes back into the definition, right? Where if we don't have a defined way to use this moving average, we're going to get confused. We're going to get this kind of, it's called analysis paralysis, where you look at so many sides of things that you can't even figure out kind of what's right and what's wrong. It's kind of like we were just finishing watching Loki, kind of like Marvel and all their timelines, where you look at all the timelines from all these different perspectives, and you do all this stuff and you just get confused. You forget where you're at and what you did, right? So you got to make it defined, where it's like, hey, I used the moving average on my higher time frame to define trend. But then once I go down to my entry time frame, right, they don't really play a role. Using them as a way, you said, hey, a good place to put a stop loss buy, right? that was a great idea here on the 4 hour, but our trade entry, right? What time frame did our trade entry come on? Did it come on the 4 hour? No, it came on the 15 minute. But as soon as we get to the hourly and the 15 minute, right? Our moving average is above our trade. So can we use it as a stop loss? Well, no, we can't use it as a stop loss if it's above our entry, right? So let's make sure we define it, when we use it, how we use it, what time frames we use it on. It eliminates that confusion, eliminates that paralysis analysis, and then we can actually kind of harness the full power of it. So, all right. So next we went down to the 15 minute, I think Gary said, and the entry was a double bottom right here. I think correct me if I'm wrong. My memory is short. Entry was the double bottom. I think I read that. I think double bottom RSI was oversold. And there was divergence going downwards. You look at price action all the way from here. You can look at our relative strength index, which I'm using. I don't know if Gary was using the same thing. Could have been using maybe a MACD. But you can see clear divergence as price action is putting in lower lows. Our indicator or oscillator is putting in higher lows, some divergence there, so adding those scores up. And my guess would be the entry would be at the double bottom. So now the next question is stop loss. What are the rules for stop loss here? So I got in my trade, I got my higher time frame, bullish bias. I got my pullback into a key level of structure. We held this structure. I've got my RSI divergence. I've got the RSI oversold. I've got a retest of the bottom. I've got everything I need to take the trade. Bang, bang, bang. I got the moving averages on the higher time frame, confirming it. I'm assuming my reason for entry was a completion of the double bottom. So we got our entries. We know we need to know entry stops and targets. Now, what are my stops based off of? How do I place my stops? What were my stops placed off of? All right, so we'll just finish up. If we get rules, we'll get rules. But let's just say we're using the ATR based stop and kind of give you an idea of what we're looking at here. And then we'll let you guys can chime in with us. So if we're looking at an ATR stop, right? We're looking at an ATR average true range of about 14. We're looking at the low of our double bottom right here. Oops, I don't have one, and just try to hide it behind an MA or structure. Yep. Well, so you can see here on the 15, we can't hide it behind an MA because the MAs are above our level. And then the question is structure. Well, the double bottom completes below structure. So where below structure do I hide it? So I think those are both good ideas. Again, for the moving average, it has to be relative to a specific time frame. For structure, just you'll have a rule. Now he's on the 4 hour. Now here's I'll be very careful because from the 4 hour to the 15 minute is a big gap. I'd be very careful with using. I've always been a fan of basing my stop losses off of the time frame I'm entering the trade on. You want to be careful with using such higher time frames to place your stops, because again, a 4 hour will sometimes give a completely different picture than the 15. So it's not always the case, but sometimes you got to be very careful because you see the range on the 4 hour is going to be so much larger than that of the 15. So let's look at the 4 hour right here. Let's look at the time that the trade was executed. It would have been right in this area. So if we're using our moving average right now is right at 169.42. So let's say we're doing 10 pips below the moving average, 169, what did I say, 42? 169.44. So that's going to be, let's say, 34 at the time of this. Boom, right there. We go down to the 15 minute, right? And that's going to be right down there. So that may either be perfect for you. It could be too large. But just be careful when you're using like bigger time frames for your stop loss. I prefer to use it off the trading time frame. But there's no wrong or right answer for that. That's just kind of, I don't even want to say advice, just kind of what I do. So let's say we're doing 10 pips below the 4 hour on the 10 pips below the moving average on the 4 hour, okay? And the next question, right? We got entries, we got stops now. What would be targets? What would be targets, or what are targets, I should say? I'm assuming those are based off 4 hour as well, I would guess, right? Retest of the highs, maybe? So retest of the highs? Right here. Boom. So we're looking at a situation like this. Oh, sorry, wrong chart. 15-minute chart. And we're looking at a situation in Gary's trade. Oh, not a short one, a long one, sorry. We're looking at an entry probably right here if we're taking a double bottom. We're looking at a stop loss right here. And then a target right at the very highs right here. 4-to-1 risk reward. You guys like that? You like that? Sorry, that's a Kirk Cousins reference that if you're not an American football fan, you won't get. But it's also something I yell at my screen whenever I get a good trade. You like that? Right? You guys like this trade? Any questions or comments? I like the idea. Again, we touched on a little bit of the rules that need to be sharpened up. But I like the idea. There's one thing I would add, but I see if you guys type it in first. I'll let you guys get to it. So the only thing I would add, we spoke about this. We spoke about this earlier with the what's this? The euro yen, the euro dollar situation, which we need to double check on and see if we got an order on. Active trade management, right? So you gave yourself enough breathing room to avoid this dip, right? This is why we don't have stops that are like 1 pip below your entry, because guess what? You would have been skunked out, then the market went in your direction. This is why we have those breathing room, right? Soon as that double top was violated here, boom, that's confirmation, right? That's confirmation in the move higher. Doesn't mean that we'll go to our ultimate destination. But at this point, we still don't know if the market's going to go higher or lower. This is confirmation, right? Once we have that confirmation, that gives you the opportunity to tighten those stops even more. Because if you're right, guess what shouldn't happen? We should not come back down to here. Honestly, we shouldn't come past this low right here, to be honest with you. So now it's that risk management where you take care of your risk. You have zero or very limited risk on the back end, and boom. Now you're kind of playing with house money. So good job, Gary. I like it. We'll keep sharpening up those rules and working with you, but thank you for being kind and courteous for this little trade review. Your fellow traders learned a lot from it, which is going to be very important. Hope you enjoyed the video. I wanted to give you the heads up that we are re-uploading the Cyber Trader Workshop videos. If you guys missed it, the Cyber Trader Workshop was a free 4-day online trading workshop that we hosted, late October, I believe. And well, thanks to popular demand, we are bringing back those recordings for the few people that missed it. That way you can check them out. But they're only going to be available for a limited time, so make sure you check your email. Make sure you watch this space so you don't miss it, because once they're gone, they're gone. All right, check it out, and I'll see you guys next week.